Good morning, everyone. How's it going? It is 6 a.m., half an hour before we open the first day of the month, February 1st. So yesterday we had the FOMC meeting. We had some big earnings that gave us a lot of volatility within the price movement of the stocks themselves. But when we looked at the volatility index, the VIX, it didn't move up that much. So we're going to examine that relationship a little bit more carefully today to help give us a idea of any directional movement that we might have. And so we want to look at VIX very carefully. We'll take a look at futures, but on a morning like today, we're not going to put too much credence into what we see there because we also have some really big earnings happening tomorrow. So any big move unless it's decidedly directional and goes through important support or resistance levels. We're not going to read too much into it. So we have to take everything with a grain of salt today. It could look like there's a lot of movement, but that could just be volatility, intraday volatility. And if that intraday volatility stays in equities, it doesn't bleed over into the options. Remember, VIX measures the options. It's how big of a movement are the market makers within the options expecting. That's very different than the intraday price movement of a stock. So the options is a deeper look. So if that movement in the stocks doesn't translate over into the VIX or into the individual stocks options, then the chances are is that we're not actually going to move because we control more shares via the options, at least in the big names like SPY and Apple and Microsoft, all the FANG stocks. We control more shares in the options market than we do in the actual equities markets. Why? Because they have to hedge themselves. Market makers have to hedge themselves. If we start trading heavily inside of these names in the options markets, then the market makers, in order to hedge themselves, will actually buy and sell the actual shares within the equities markets. So there's a lot of influence by the options market on the equities market. So we have to see the volatility translate into the options market for us to believe that we're actually getting a directional movement. So let's take a look. We will start with futures, even though I said we're not going to read too much into it if we see anything wild. And not really. Dow is flat. S&P is up, but not, I guess, 0.4. Yeah, around 0.4%. And then the NASDAQ up around a little over half a percent. So normally we call that non-random, but today I'm just going to call that maybe random. So we are getting the opposite reaction. So remember, we're talking about FOMC. Normally, at least in the pattern while Powell has been around, is after the announcement, whatever move we get, we start to undo the next day. And actually, we have a tendency to completely undo. And I said that today, I wasn't necessarily going to expect it to be completely undone because of the uncertainty that the earnings tomorrow have. So we are starting to see that bounce back up, but will it overwhelm where we were yesterday? It's so too early to tell, but here in the SPY, you can see this bounce just goes up to here. That's not even halfway up the entire red bar that we had yesterday. And there was a little bit of a gap down yesterday as well. So for this entire move, it's maybe not even a quarter, maybe 20 to 25% of the move that we had yesterday. So are we going to make up the remaining 70 to 80% in today's session? There would have to be some really, really positive enthusiasm in the market in order for us to do that. So I doubt it. If we retrace, maybe if the market is really strong, we retrace to the top of this candle. But I don't see that happening, or at least not too much probability of that happening. And then if we get really solid earnings out of Amazon, Apple, and who's the other one? Meta? I'm not sure. Did Meta? No, not Meta. unless this isn't updating, which I don't think it is because I don't have it. Yeah, Meta. So unless we get some really positive earnings out of those guys, I don't see overcoming this high right here. We're probably going to chop, or if the news is bad, we're going to go down. If we look at Apple, based on the action that we've had so far, it's not looking too good for Apple. The market doesn't seem to expect positive things out of Apple. The reason I say that is, let's go over here and get a cleaner chart. I'll remove these for now so we can get a larger area to look at. And let's compare this to the SPY. I just care about this period right here. Well, okay. So the point is, over here, when the S&P consolidated, the Apple went down, and it went down hard. It gapped down to these lows right here. And then when we went back up, Apple led the way down. So I would say, because Apple's big enough, that Apple dragged the S&P down. You see, it led the way down. The S&P continued to move up for a little bit before it came down, and Apple's coming down really, really hard. And then if we go back to the chart we were looking at earlier, we can see that Apple broke down in the last couple of days. It broke some major moving averages. And just in the last 3-4 days, we broke below the EMA 8, the MA 50, the EMA 20. The EMA 20 never made it above the MA 50. Now we're all the way down to the MA 150 and MA 90 with some really strong, large bar movements and on normal volume. So what I would expect based on what I'm seeing in this volume and price action and the fact that we've been leading the way down in Apple is that if we didn't have earnings, we would trade down to the MA 200, maybe pause there and maybe bounce. Or if we went through, then we would expect continued downward movement. So prices leading up to earnings, what this picture tells me is that for whatever reason, in the last 2 weeks before earnings, some enthusiasm came in for Apple. There might have been some sort of expectation. There might have been rumors of something or rumors of earnings. And then in the last week, we completely undid that. Said, actually, we don't think so. It gapped up, went up so strongly. Now we're dropping dramatically and beginning to fill this gap. We're halfway through this gap right here. So that's not painting a really good picture for Apple. So unless there is a really big Apple earnings surprise, this is probably at the very least going to go down to that MA 200. I would not be buying puts in Apple though, because right before earnings, volatility, we just talked about volatility. Volatility is really large, or the expected move becomes really large. So if you try to go and trade Apple, especially since the last 2 weeks, the range has been so huge, I would be very, very, very surprised if the market maker move is small. So let's take a look at Apple. We have earnings tomorrow, or tomorrow. So so we can see this implied market maker move, implied volatility, 71%, and after tomorrow, so into next week, we drop all the way to 38%, and after that, down to about 30 or 25%. So right now, volatility is huge. So if I go to try to buy a put right now, it's really expensive. What that means is at $184, if I buy a put, we've got to move at least $6 and roughly 50 cents. So we've got to move all the way down to 178 or lower for me to just begin to make money. Just for me to break even, I should say. So if I look at 178, let's see where that is. So that's pretty big move. That's a gap down below the MA200. And let's say percentage. So we got a gap down at least 3.5% for me to begin to make money. So obviously it's got to move even further for me to actually make money. So I would not be buying a put today. The opportunity to buy a put was 1 to 2 weeks ago, not right now. So it's very difficult to buy a put or a call the day before earnings or the session before earnings in order to try to make money because that volatility widens so much. If you're going to do it, it would be done via spreads or most likely spreads. So overall, Apple is not painting a great picture for us, but that's speculation. So what is actual reality is that we are still on this uptrend. And actually, if I draw it this way, where we draw it through the lows, we ignore this one, because this was more of a sideways movement anyways, so I can't really call that a low. So here, if I hit this low, then the next swing low, and now potentially we're at another swing low. If this line holds, we're still in an uptrend. If we break through this, we might consider it a change of trend, but we won't until we have a confirmed lower low. So this would have to fall through all the way through at least this first purple line right here. And then I would need a lower high. So it would bounce back up probably to the same line that I just drew and then head lower again. Then I would have a confirmed change of trend. Right now, we have a suspicion or a risk that we might begin a change of trend. Why? Because we're right at the line. So here, there was that risk also. Here, there was that risk also. They didn't pan out. It's possible that this doesn't pan out and we continue on this uptrend. So we don't want to go contra trend. At least we don't want to have a lot of positions contra trend. We want our portfolio still leaning to the positive side until we get that change of trend or confirmation of change of trend. So wait and see. That's basically the theme of today is wait and see. We have some major announcements tomorrow, and that will change the picture. That could change the picture dramatically. But based on what we're seeing right now, we're not going to believe in a change of trend quite yet. Apple kind of gives us a clue that it might. But when we looked at, for example, VIX, VIX is not quite elevated yesterday after that huge move, where VIX is actually lower than the day before. Wait, that was yesterday. Sorry. Right now, we're lower than the day before. But after that huge move yesterday, we didn't really spike up. This looks like a normal bar within this range right here. So VIX isn't reacting. That means market makers are not fearful of a large move yet. And so VIX basically says, no big deal, not yet. So we don't have a confirming story in VIX. And then what we saw yesterday's CLT is like, I was kind of surprised that we broke above the MA200 and we still had a positive green bar and a move higher on the close in TLT, given that Powell insisted that we're not going to cut rates in March, which means higher rates longer. We would expect this to come down, bouncing off of that MA200 and come down. We didn't get that. So basically the bond market and the options market is not confirming the fear in the equities market that we might break down below this. And actually, even the equity market isn't saying change of trend yet. We're still holding this line. So any speculation that we're going to break down is just our fear talking. So we don't want to buy into that. We just want to say, hey, okay, yes, there is potential. There's higher risk. There's higher potential than a few days ago. But, there's nothing to tell us that that's actually the case yet. And therefore, that's the time to prepare. That's the time to hedge. It's the time to buy insurance rather than, sell everything and flip to the short side. So now we have a little bit more clear picture. We don't want the fear to get the best of us. And we want to sit and wait and see what happens with Apple, Amazon, and Facebook. So I'm going to end it there. I've been talking for a while, longer than I expected to. And I think we have a pretty complete picture. We don't have to go through the sectors and the news and all of that. Basically, nothing is going to trump the earnings news that we're going to get in the next 24 hours. So don't get shaken out of your positions. Don't get too excited if you see a lot of price movement. That's fine, as long as it doesn't translate over into VIX. So maybe keep an eye on VIX. And as long as it doesn't translate over into the bonds market, then just treat it as noise. All right, so that's going to be it for today, and I will see you guys in the aftermarket.